Hi everyone, what's up? Welcome back to my tutorial channel. It's Daniela Tran here, and today we are going to work on some problems that I collected from the IFM Practice exam. This video is about section 2.2. First, problem 1. According to the corporate finance by Burt and DeMarzo, which of the following is our self-financing portfolios? 1. The risk-free portfolio. 2. High minus low portfolio. 3. Small minus big portfolio. 4. Prior 1-year momentum portfolio. 5. A portfolio consists of the market portfolio long position and the risk-free asset short position. Alright, so in order to answer this question, let's recall the self-financing portfolio. Note that on the Pharma Friends cohort FFC factor specification, we have the model expected return of RI is equal to the risk-free assets RF plus beta of the portfolio I respect to the market portfolio time with expected return of the market portfolio subtract RF. This is the risk premium. You see expected return of RM subtract RF is the risk premium. And remember, beta is the measure to the measure of sensitivity between the portfolio and the specific factor. Now we have three more factors. We has SMB is small minus big. HML is the high minus low, and PR1YR is the prior 1-year momentum factor. And on the Pharma Friends cohort FFC factor specification here, we got RF is the only portfolio that doesn't have beta. It doesn't have any sensitivity respect to any other factor. And we got these four factors: M, SMB, HML, and PR1YR. These are the four factors in the model. And here the four factor here is called the self-financing. The self-financing portfolio basically just the one that costs nothing to construct, and they should have the sensitivity respect to the portfolio that we are investigating. So here we got four self-financing: M, SMB, HML, and PR1YR. RF is the only one that has no beta, and this is not the self-financing. So only the risk-free portfolio is not self-financing. The answer is 1. See that? Problem 2. A well-diversified portfolio X is modeled using a 3-factor model. Rx is equal to alpha plus beta 1I1 plus beta 2I2 plus beta 3I3 plus epsilon X, where alpha, beta 1, beta 2, beta 3s are constants, and I1, I2, and I3 are random factors. Which of these statements are true according to the arbitrary pricing theory? Number 1. The epsilon X is approximately 0. Number 2, epsilon X follows a Boyson process. 3, epsilon X follows standard normal distribution. Number 4, epsilon X follows normal distribution with unknown mean and standard deviation. Number 5, none of the above is true. So let's justify each of these statements. First, epsilon X is approximately 0. This is true because on any model, F sum x represents for the error between the expected value and the true value. So usually we have high expectation that the estimate should be really close to the true value. That means we expect small error. So we expect F sum x is approximately 0. Another way to think about it is expected value of F sum x should be 0. So 1 is true. 1 is true. Now for statement 2, F sum x follows a Poisson process. This is completely wrong. For any factor model, we have F sum x should follow normal distribution. That is the assumption for any linear model. Number 3, so 2 is incorrect. Number 3, F sum x follow standard normal distribution. This is incorrect because there's no way to guarantee that the standard deviation of the distribution of F sum x is 1. We know it's follow standard normal. We know it's follow normal distribution, but there's no way to guarantee that the standard deviation should be 1. Number 4, F sum x follow normal distribution with unknown mean and standard deviation. This is wrong because we should know the mean. Mean is 0. F sum x follow normal distribution with mean 0 and unknown standard deviation. So this is partially correct. But if we justify the whole statement, this is incorrect. So we got 1 is true, 2, 3, and 4 are false. So of course 5 is false. So the answer is 1. I repeat, 1 is true. The second statement is false because errors shouldn't follow Poisson process. Number 3 is false because there's no way to guarantee the standard deviation is 1. Number 4 is false because F sum x should follow normal distribution with 0 mean, not unknown mean. And 5 is incorrect because 1 is correct. So answer is 1. Problem 3. Which of the following is true with regard to small minus big SMB portfolio, a self-financing portfolio discussed in Corporate Finance by Burt and DeMarzo? 1. It consists of short position in stocks with high book-to-market ratio and long position in stocks with low book-to-market ratio. 2. It consists of long position in stocks with high book-to-market ratio and short position in stocks with low book-to-market ratio. 3. It consists of a short position in stocks with high market capitalization and long position in stocks with low market capitalization. 4. It consists of long position in stocks with high market capitalization and short position in stocks with low market capitalization. Number 5. None of the above is true. So, remember in the Pharma Friends cohort model, we got SMB, we got HML. SMB is small minus big and HML is high minus low. And I want you to keep in mind that SMB should go with capitalization, market capitalization, and XML should follow the book to market ratio. So here when we read this statement, we can go ahead and eliminate 1 and 2 because SMB is not relevant to the high book to market ratio and the low book to market ratio. So we can go ahead and eliminate 1 and 2. Now we have to look at 3 and 4, the market capitalization. Now read it again, small minus big here remember plus mean buy and minus mean sell. And of course when you buy stocks, you actually have a long position. And when you sell stock, you got short position, or another way to think of it is short selling. So basically here we have to buy small and sell big. So basically we have to buy something with small market capitalization and sell something with high market capitalization. So basically we have to long position in stock with high long position with stock with low capitalization, and short position the stock with high market capitalization. So the answer is 3. See that? The small minus big SMB portfolio is a self-financing portfolio that is constructed by buying stocks of companies with small capitalization, small stocks, and short selling stocks of companies with a large capitalization, big stocks. This investment is also called the market capitalization strategy. So remember, short means sell. Short is sell, and long is buy. Number 4. The returns of 3 assets are modeled using a single factor model, where f sum I is a random variable with 0 mean, and Rm is the return of the market portfolio M. In addition, Rm and beta i's are independent, and f sum I and f sum j are independent for any I not equal to j. You are given the following information about the 3 assets, x, y, and z. For each of these, we got alpha, beta, and variance of the error f sum I. In addition, the market portfolio has an expected return of 10% and a variance of 0.25%. Calculate the correlation coefficient between the return x and z. So for this problem, the question asks to find correlation coefficient. So remember, there's a formula that can make connection with correlation coefficient, that is covariance. So in order to calculate correlation coefficient between x and z, we have to first find covariance between x and z, right? And also we have to find sigma of x and sigma of z. So let's look at x and x first. X, by using the single factor model, we got Rx is equal to 0.02 plus 0.6 Rm plus f sum x. So from here, if we find variance, we got variance of Rx is sigma square of x. This is equal to 0.06 squared times with variance of the market portfolio, which is 0.25%, plus variance of f sum x, which is 0.06%. So variance of Rx is 0.15%, leading to sigma x is 0.0387. Y, now for z, similar, we find sigma of z is 0.0687. Now let's find covariance between x and z. Covariance between Rx and Rz is equal to 0.06 times 1.3 times with covariance between Rm and Rm, and it should be equal to 0.6 times 1.3 times variance of Rm, and the answer is 0.00195. Here variance of Rm is 0.25% from the question. So now we have covariance between x and z. We got sigma x, we got sigma z, so we can go ahead and calculate the correlation coefficient. Rho xz is equal to covariance between x and z over sigma x sigma z, which is 0.73. Right. Problem 5. You are given the following information with regard to the three-factor model discussed in corporate finance by Burt and DeMarzo and the three Ricky assets. Here we have the three Ricky's assets, so we are going to use a multi-factor model. Calculate the expected return of the investment. Here we got three factor, 1, 2, 3, and we got three Ricky assets. The three factors have expected return 11%, 7%, and 8% respectively. Volatility of the factors portfolios 5%, 1%, and 1.5% respectively. For the three assets, we got expected return of the risk-free assets is 4%. Beta 1 of A is 1.2. Beta 2 of A is 0.2. Beta 3 of A is negative 0.4. Beta 1 of B is 1.6. Beta 2 of B is negative 0.1. Beta 3 of B is 0.7. And you invest $200 in assets A, $300 in assets B, and $500 in the risk-free assets. And the question is just calculate the expected return of the investment. So the portfolio of the investment is 20% in A, 30% in B, and 50% in F. Right. So in order to find expected return of the investment, we have to first find expected return of each of these three Ricky assets. So let's look at A. Of course, for this problem, we are going to use multi-factor model of risk. But first, let's look at expected return of A. Expected return of A here is equal to 4%, which is RF, plus 1.2 beta 1 of A, time with 11% minus RF 4%, plus 0.2 times 7% minus 4%, minus 0.4 times 8% minus 4%. See that? This is the multi-factor model of risk, and we got 11.4% is the expected return of A. Similar, we find expected return of B using the 3 beta and the 3 expected return. And don't forget to subtract risk-free asset in each of the factor. We got 17.7%. Now we can construct the portfolio of the investment. We got expected return of the portfolio is equal to 0.2 times expected return of A, plus 0.3 times expected return of B, plus 0.5 times RF. Because we invest $200 in A, $300 in B, and $500 in F, the total is 1,000. So we invested 20% in A, 30% in B, and 50% in F. By decimal representation, we got 0.2, 0.3, and 0.5. And from here, we got expected return of the portfolio is 9.59% of the investment. So the expected return of this investment is 9.59%. All right. Now we have seen two different models in this practice. So I just want to give you a note on the APT and FFC. APT is the arbitrary pricing theory. APT. It is basically the multi-factor model of risk, and this is developed by from the single factor model. We got expected return of RI is equal to RF plus beta I1 times expected return of the first factor, subtract the risk-free assets, the risk-free portfolio return, plus beta I2 time with expected return of the second factor, subtract RF, and so on. Here we suppose there are n factors in the model. N factors in the model. And if we compare to the single factor, model, we got expected return of RI is equal to RF plus beta I times expected rate of return of the market portfolio subtract RF. Here we got, this is the risk premium, remember. So basically the multi-factor model is developed from the single factor model by adding more factors. But here in the multi-factor model, we don't mention the market portfolio. And the advantages of this is just try to capture all the systematic risk that couldn't be captured in the market portfolio. The disadvantage is it's just hard to estimate its expected return because we have so many different factors in here. Now for the Farmer Friends cohort FFC factor specification, we also have different factors, but some of them is not risky factors, and they are portfolio. They are self-financing portfolio. So basically, for any risky portfolio, we have to subtract RF. Otherwise, otherwise we don't have to subtract RF in the parenthesis. We got expected return of RI here is equal to RF plus beta IM times expected return of RM subtract RF plus beta I SMB times expected return of SMB plus beta I HML times expected return of HML plus beta I PR1 YR times expected return of PR1 YR. Here, the market portfolio is the only risky portfolio, so we have to subtract RF. See that? So if you compare between the APT and the FFC, we see that the end factors in the APT are risky portfolio. That's why we have to subtract RF. But in the Farmer Friends cohort, these are not risky, so we don't have to subtract RF. And the 3 self-financing, here we got 4 self-financing. Market portfolio is also a self-financing portfolio, but only the last 3 has positive alphas that capture some parts of systematic risk that AM failed to represent. Alright, so that's it for today. Thanks so much for watching. I hope you guys enjoyed my video. If you like this video, please like, share, and subscribe. Thanks so much. See you next time.